Hey everyone, Roy here, and welcome back to The Explainer. Imagine finding an IPO with nearly 50% EBITDA margins, almost zero debt, a reported 34.7% return on capital, and revenue growing at roughly 33% annually. Sounds like an absolute goldmine, right? But what if I told you there was a massive 495 crore rupee catch hidden deep in the fine print? Today, we're diving into the massive influx of Indian IPOs this August. We're going to look at the good, the bad, and the highly risky, and learn exactly how to spot those hidden red flags past all the market hype. Here is our roadmap for today. We'll kick things off with a massive August IPO rush, shine a spotlight on some mainboard heavyweights, do a reality check on Shiprocket's valuation, dig deep into SME IPOs and their hidden risks, and wrap up with some golden rules for investing.
All right, let's jump right into Section 1, the August IPO rush, and decoding this massive capital influx we're seeing.
Just to give you an idea of the absolute frenzy out there right now, take a look at Dude Transmission. This is an electrical and electronics company, and they launched a massive 3,067 crore rupee issue. Well, guess what? By day 3, it was already subscribed 7.87 times. The non-institutional segment alone booked it almost 25 times over. I mean, money is just pouring in from literally every corner of the market. So what's driving all this hype? Well, you really can't talk about IPOs without talking about the gray market premium, or GMP. If you're new to this, GMP is basically the unofficial premium that shares trade at before they officially list on the exchange. It acts like a mood ring for retail sentiment. When people see a high GMP, they immediately think, oh, guaranteed listing gains, and that just pours gasoline on the fire. But as we're going to see today, chasing that premium without checking the actual fundamentals is playing with fire. Moving on to Section 2, let's spotlight some of these high-profile mainboard offerings. We've got a pretty diverse lineup making waves right now. You've got companies like Bihari Lal Engineering, Molbio Diagnostics, and Milky Mist Dairy Food, all raising serious capital, but their strategies are totally different. Bihari Lal is coming in with a more modest 301.62 crore issue, while Milky Mist is going absolutely huge, targeting over 1,550 crores. And what's fascinating is how the market is responding to their specific fundamentals. Take Bihari Lal Engineering, for example. They're signaling a really solid 23% listing gain based on a 67 rupee GMP. Why the optimism? Well, they've got clear plans to use those funds for a third manufacturing plant, which would really boost their operating leverage. Then you have Molbio Diagnostics, raising fresh capital to expand their capacity, and analysts are pointing out that their valuation is actually pretty reasonable compared to industry peers. So in these cases, the hype actually seems to have some solid fundamental backing. But let's flip the script a bit. Section 3, Shiprocket, and why we desperately need a valuation check to look past the hype. Okay, listen, just because an IPO is from a massive, famous brand doesn't mean it's a slam dunk. Let's look at Shiprocket. On the surface, incredible. They're the largest e-commerce enabler in India. We're talking 2.1 lakh active customers and over 2,024 crores in revenue. Huge, right? But pull back the curtain and reality hits hard. They have been completely loss-making between FY23 and FY26. Their emerging segments are running at a negative 30% EBITDA margin. And despite all that red ink, they are asking for a valuation multiple of 356 times their adjusted EBITDA. That's just wild. To really put that absurdity into perspective, let's compare them to a profitable peer, like Unicommerce. Unicommerce is trading at an EV to EBITDA multiple of about 27x. Then you look at Shiprocket asking for 356x. That is a massive flashing red flag. Add to that the fact that over the last decade, they've raised over 2,400 crores in funding, but their capital efficiency ratio is stuck at a dismal 1.1x. This is a textbook example of how massive scale can completely mask deep underlying inefficiencies. This brings us to Section 4, SME IPOs and hidden risks. Let's get into the Pramodini Medicare case study we talked about earlier. This is where things get really interesting and why you literally always have to check the data. We're looking at the SME space, which is super volatile, and specifically Pramodini Medicare. Now, on paper, this looks like an absolute goldmine. I mean, look at these numbers. A 49.6% EBITDA margin. That is almost 50%. Revenue growing at a 33% compounded annual rate over 3 years. A 34.7% return on capital employed, and basically zero debt. Honestly, it looks flawless. These metrics seem totally perfect for a small 118 rupees per share IPO hitting the NSE Emerge platform. It genuinely feels like finding a hidden gem. But you know how it goes. When the numbers for a microcap look this flawless, you've got to ask yourself, what exactly is the hidden catch here? Well, if you dig deep into the prospectus, there it is, a massive hidden contingent liability. They've provided a 495 crore rupee guarantee to a group company. I mean, let that sink in for a second. The entire issue size of this IPO is barely 6.9 crores, yet they have a contingent liability of nearly ₹500 million rupees just hanging over their heads. If that guarantee gets called in, it's game over. It could literally wipe the company off the map. And it doesn't stop there. There's another huge operational risk hiding in plain sight. A staggering 65% of their FY26 revenue comes from just their top 10 customers. Think about how dangerous that concentration is. There is so much vulnerability baked into this business model. If even one or two of those key clients decide to walk away or switch suppliers, those beautiful 50% profit margins we were just admiring will vanish into thin air. So, how do we protect ourselves? Section 5. The golden rules for navigating the IPO market safely. Because we can't just blindly follow the herd, we need a game plan. Step 1. Always evaluate a company's operating history. So many of these IPOs are just really young businesses without a proven track record. Step 2. Check the valuation metrics. Like we saw with Shiprocket, these things are often priced on future hype, not actual past performance. And step 3. Assess the business and liquidity risks. You have to hunt for those hidden contingent liabilities and customer concentration risks, exactly like we did with Pramodini Medicare. You've got to remember, the market environment right now is incredibly volatile. As retail investors, it is so easy to fall into psychological traps, right? You see the social media hype, you see these massive oversubscription figures, and you just start making emotional decisions out of pure FOMO. Plus, you always have to keep an eye out for lock-in expiry pressure. That's when early anchor investors dump their shares after 30 or 90 days, which can cause the stock price to absolutely tank. Look, the IPO market can be incredibly rewarding, but it is definitely not a lottery ticket. Before you go locking up your hard-earned capital in the next big IPO rush, I want you to ask yourself one final question. Are the potential short-term listing gains really worth the underlying fundamental risks hiding in the fine print? Do your homework, read the prospectus, and don't just buy into the hype. Thanks so much for joining me on this explainer, and I'll see you in the next one.